Good afternoon, everyone. Thanks for joining us today. If you don't know, I'm Matt Greco. I'm the events manager here at PSS Life University. And today we're very pleased and lucky to have Ed Zurndorfer talk to us about qualified distributions. Ed is a very experienced financial planner. He's the owner of Easy Accounting and Financial Services in Silver Spring, Maryland. He's a CFP, a CPC, and many other, an IRS enrolled agent, has many other qualifications, and talks all the time to federal employees about retirement strategies. And today, he's going to be talking to us about retirement strategies in terms of qualified distributions. As you just heard, we're talking about questions. If you have them, just put them into the chat, and Ed will deal with them as we go along. And with that, I'll hand it over to Ed.
Thanks very much, Matthew. Good afternoon, everyone. Thanks for joining us. I want to thank Matthew for giving me this opportunity to do today's webinar. He arranged this, and I really appreciate him, finding me and giving me this opportunity. And I would like to welcome everyone to this presentation. We're going to be talking about qualified distributions. Again, if you have any questions, rather than waiting to put to the end, if you have a question as I'm presenting, please put it in the in the chat box, and Matthew will read it. There's no such thing in this business as a dumb question. The only dumb questions are when you don't ask. So please, without hesitation, put those questions in the chat box, and I'll be more than happy to answer the question. All right, with that, let's go ahead and get started. Question: what is a qualified distribution, and what are some of its characteristics? A qualified distribution is a withdrawal from a qualified retirement plan. For example, a 401k plan. A private company offers a retirement plan, and there are different types of retirement plans. Most common ones are 401k plans, 403b plans, and in order to be a qualified retirement plan, as we're going to find out, it has to follow certain rules given by the IRS. Another type of qualified distribution can be from an IRA. Maybe you own an IRA, individual retirement account. IRA started actually 50 years ago in 1974. I started my practice at that time, and I remember how popular IRAs were. One of the most popular aspects of the IRA is that you put the money in, you get a tax deduction, federal, in most cases state, and then the money in the IRA grows tax deferred. And then when you pull the money out of the IRA, later in retirement, you can use it to pay your expenses in retirement. Now, there's a confusion a lot of times when it comes to IRAs, and people say to me, well, I've gotten this question many times. Ed, I put money into my 401k plan, or here in the Washington, D.C. area, we have a lot of federal employees who put money into the thrift savings plan, which is like a 401k plan. And the question is, Ed, because I put money into my 401k plan, I contribute to my retirement plan, I'm not allowed, therefore, to contribute to an IRA. Nothing can be further from the truth. There's only one requirement to contribute to some type of IRA, whether it's a traditional IRA. We're going to also be talking about the Roth IRA, and that is to make a contribution, you must have earned income. What is earned income? A salary, or maybe you're self-employed. You have a net profit from your business. And there's no age limit, by the way, when it comes to contribute to an IRA. I'm sure many of you are retired. Maybe you are in your 60s, maybe 70s, maybe 80s. And I've seen retirees go out and get a part-time job so they continue, in order for them to continue to make contributions to their IRA, and they take the money out maybe immediately, or they take the money out down the road to help pay their expenses in retirement. And by the way, I mentioned about the earned income. If you're a married person, it only takes one of you to have that earned income. And that results in allowing both of you to contribute to your own IRAs. IRAs are not joint accounts, they're individually owned. All right, what else about the qualified distribution? it comes with tax and penalty conditions as established by the IRS. The IRS is the one who sets the rules regarding what is a qualified distribution. And there are penalties involved with qualified distributions. Let me give you one example of a penalty. Suppose you have an IRA. What is the earliest age you can make qualified distributions from a traditional IRA? The answer is 59 and a half. If you're under 59 and a half and you just take the money out, you want to take it out of it, you're going to pay a 10% early withdrawal penalty. There are some exceptions, and I think I'll be mentioning those later on. But in general, you cannot take money out of a traditional IRA until you're 59 and a half or older. Qualified retirement plan participants can make qualified distributions from their retirement plans if they retire at age 55 or older. Now, let's remember that when it comes to qualified retirement plans, like a 401k plan, like a 403b plan, there are different rules when you can take the money out. Rule is, when it comes to a 401k plan or a 403b plan, if you retire from a private company in which you put money into their 401k plan, you can make penalty-free withdrawals from your 401k plan if you retire sometime during or after the year you turn age 55, not 59 and a half, not 59 and a half, 55. Traditional IRAs, here it is, must be at least age 59 and a half to make penalty-free withdrawals. And the taxable portions of non-qualified distributions, here's that 10% early withdrawal penalty. If you take the money out of your qualified retirement plan before age 55, or you take money out of your traditional IRA before age 59 and a half, you want to take the money out, you're going to pay, in addition to the taxes you have to pay on the distribution, you have to pay a 10% early withdrawal penalty. And that really is important, because remember, you saved all these years for your retirement, and now you got the benefit putting the money in, a tax break. You got you made before the tax pre-tax contributions from your salary. Your salary was not taxed. You use that money, part of your gross salary, to put into your 401k plan, or you got a tax deduction when you contribute to traditional IRA, and then the money grew over time, it accrued earnings. And now when you take it out before 55 or 59 and a half, you're going to pay an addition to all the taxes, federal and state taxes, you got to pay a 10% early withdrawal penalty. Now, why is that? Because the idea being that these qualified distributions are for retirement. They're not for your if you're underage, you have other money to pay your bills. You have a salary, you're working, you have your salary income. Maybe you have a savings account. You're putting money into your savings account to pay the big bills you're saving over time. Your retirement money, when it comes to saving for retirement, is exactly for that, for retirement. It's not meant to pay everyday expenses. Okay. Qualified distributions, tax benefits, and penalties. The IRS offers several tax benefits to individuals who contribute to and save in qualified retirement plans. Because of these tax benefits, many individuals pay into qualified plans in order to save for retirement. There's an incentive here. And as I mentioned earlier, there are taxes. IRS imposes taxes and penalties on distributions that do not meet qualified distribution criteria. So let's do an example here. Let's do an example. It always helps if we do an example. So we have Joseph Smith. Joseph Smith works for a company, and his company offers a 401k plan. And every year, IRS puts the limits as far as how much employees can put into their qualified retirement plans. And the IRS terminology. It's called the IRS's elective deferral limit, the elective deferral limit. Now, why is it called elective? Because the employee is not being forced. The employee is not being forced to save. It's up to the employee. They have to make the decision to put money into their 401k plan, just like they have to decide to put money into an IRA. This is not the law. It's up to the employee. The employee really should be thinking about saving for the retirement starting when. I always ask the question. When I did this, I started doing seminars 25 years ago, 1999. I go around the country teaching federal employees how to save. And I would always ask the question, when should you start saving for your retirement? Answer, the day you start working. Unfortunately, many Americans started late. They figured, I got time. I got my first job when I was 25, 30 years old. I'm not going to start saving for retirement. I got time, I'll wait till I'm in my 40s. And this is a big mistake because the money that you put into your qualified retirement plan, number one, it's coming from your gross salary. You're getting a tax break. So back to Joseph Smith. This year, in 2024, Joseph Smith, under IRS rules, can contribute $23,000 to his traditional 401k plan. So if Joseph Smith decides, I'm going to put in, let's say $10,000. I'm going to put in $10,000. So as a result of contributing $10,000 to his traditional 401k plan from his salary, only from a salary, the money has to come from your salary. His taxable salary is reduced from $23,000. If his gross salary, let's say, is $100,000, he's going to put $10,000 into that traditional 401k plan. His taxable salary is reduced to $90,000. If he is in let's say, a 22% federal income tax bracket, 22% federal income tax bracket, Joseph Smith is saving 22% of $10,000 or $2,200 in federal income taxes for the year 2024. In other words, $10,000 is being sheltered from IRS for taxes now in 2024. If he lives, let's say, in New York with a 10% overall tax rate, he's saving another 10% of $10,000 or $1,000 in state income taxes. The money goes into his 401k plan, and it's growing. It accrues earnings, interest, dividends. And Joseph Smith does not have to worry about paying taxes on that $10,000 until when? Until he takes the money out after age 55. The money is growing tax deferred. Will he have to pay tax when he takes the money out? And the answer is yes. The answer is yes. So the more years that Joseph Smith contributes to his 401k plan, the more money he'll have as a retirement account, growing tax deferred, compounded over time, and the more money he's going to have once he does retire. In the meantime, he also could be putting money into an IRA. Ladies and gentlemen, I always talk about how retirees survive their retirement. How do they survive in retirement? Hopefully they're well. They're enjoying their retirement, doing things they couldn't do when they were working, traveling, recreation, but they're going to have bills. How do most retirees pay their bills in retirement? How do most retirees pay their bills in retirement? Well, they think about, Social Security. Well, Social Security, yeah, is there for the retirement, but let's clear up a misconception. Social Security was never designed to be a retirement system. Why was Social Security created? To supplement your other source of retirement income, like a 401k plan and IRAs and any other savings you have. Some individuals, and I'm one of them, are very fortunate that I have a guaranteed pension from the federal government. This is a it's called a CSRS annuity. Other federal employees have FERS annuities. These are guaranteed pensions. You're never going to outlive them. Remember that also, that when it comes to a 401k plan, to an IRA, there is no guarantee it's going to last forever. When you take the money out of that IRA, you have to be, and that 401k plan, you can't take too much out. Too much out so soon early in retirement, because once that money is gone, it is gone. You cannot be replaced. Let me just throw out one other fact about retirement today. Retirees of today and tomorrow face a problem that I know probably your parents, my parents, certainly your grandparents never faced. You know what it's called? You know what that problem is? It's called longevity risk. Longevity risk. What is longevity risk? You could outlive your retirement income. When it comes to 401k plans, when it comes to 403b plans, when it comes to IRAs, there's no guarantee it's going to last forever. When our parents, certainly our grandparents, retired, they didn't have that problem. If they did retire, let's say maybe in the early to mid 60s, they may have lived maybe 10 more years. They didn't live that long, but we're living longer today. We could, well, God willing, we're going to live into our 80s and 90s. Social Security is not enough.
Question here.
Social Security is not enough. Is there a question there?
Well, I have a question, because you're on this subject. So, you talked earlier about retirees, having part-time jobs to supplement their retirement income. Can you, if you've already started taking money out of your IRA or your 401k, and then you decide to supplement your income with a job, how does that work? Can you put money back into the retirement plans?
Absolutely. We're talking about IRAs, putting money back into IRAs.
Yeah.
Yes, absolutely. There's no law that says that once you start taking money out of your IRA, that you cannot put money back in there. The only requirement to contribute to an IRA is that you, or if you're married, your spouse has earned income. Earned income is a salary. So here you are, let's say in your 60s, 70s, and you're taking money out of your IRA, no penalty, because you're over 59 and a half, and now you're working, now you have a very part-time job. You take money out of your IRA, at the same time, you can put money back in your IRA. Now there's limits as far as how much you can contribute to your IRA every year. Like for example, this year, and we still have time, you can contribute a maximum $8,000 to, that's maximum. I'm not saying you got to put all 8,000 in, but you could put up to $8,000 into your IRA for calendar year 2024. And the deadline, by the way, is not December 31st. It is April the 15th, tax filing deadline. So you still have time to fund your IRA for 2024, assuming you have some type of earned income this year. You're going to be getting a W-2, or if you're married, you may be fully retired, but your spouse has earned income that allows you to contribute to your IRA. That's called a spousal IRA contribution. Does that answer your question?
Yes, thank you. We have a related question on this. Someone asked, what about income from self-employment? Is that treated the same?
Very good question. And the answer is, if you are self-employed, And as a result, you're a sole proprietor, you file Schedule C, IRS Form Schedule C. In order to contribute to an IRA, you need to have net self-employment income. In other words, the income, your income coming in, your gross receipts, has to exceed your expenses. You have a net profit. You have a net profit. That will allow you to contribute to an IRA. But I also want to point out that self-employed individuals who file Schedule C have other types of, besides a traditional, what we call a traditional contributory IRA, they have also opportunities to put money into what's called a SEP IRA. That's self-employed person IRA, in which you could put actually more money into the IRA compared to what's called a contributory IRA, regular IRA.
Yeah, in
So
fact, we
yes,
just got a question on that. Are there different rules for SEP IRAs?
yeah. Well, the one rule is you have to be um, you have to be self-employed. You have to file Schedule C, um, 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 and you have to have a net profit, and you can put into your SEP up to 15% of your net profit, up to 15%. So if your net profit um, um, is, let's say, I don't know, $100,000, I'm just throwing out a number here. That means you could put up to $15,000 into your SEP IRA. That's different than a contributory IRA, in which the limit this year, I assume you're over age 50, is actually $8,000. If you're under 50, it's $7,000. Yes, there are more benefits to a SEP IRA. There's a SEP IRA is a little more beneficial than a contributory IRA, mainly because you can put more money in. But again, you got to have that net profit.
And a follow-up question, what about qualified distributions, though?
Qualified distributions from a SEP IRA.
Yes.
Yeah, it's the same rules as qualified distributions from a traditional IRA. You have to be over 59 and a half, 59 and a half. Um, and then you still could be working. You still could be working um, when you are taking money out of your SEP IRA, which means you could put money back in your SEP IRA if you have that net profit. You're taking money out of your SEP IRA and you're contributing to it. And finally, one other thing I got to mention about SEP IRAs, IRS has a rule that once you reach age 70 and a half, 70 and a half, I think it's still 70 and a half, unless they raise it now to age 73. For many years it was 70 and a half. Once you reach 70 and a half, and you are if you're self-employed, you can no longer contribute to your SEP IRA. No longer contribute to your SEP IRA. But if you're over 70 and a half and you're self-employed, you always can put money into your, again, let's use the word contributory IRA. That's a regular IRA, contributory IRA. Any more questions, please?
Yeah. So we have another question. What happens if you contribute to a Roth IRA without having earned income?
The IRS is going to consider it to be what's called an excess contribution because you or a spouse did not have earned income. You're not allowed to contribute to any type of IRA, including a Roth IRA. What's going to happen is when your Roth IRA custodian sends a copy of your Roth IRA account, a summary of your Roth IRA. It's called IRS Form 5498, in which your IRA custodian reports that you own a Roth IRA. On that report, it shows that you contribute to it. IRS, when you file your income tax return, is going to notice that you don't have any earned income. No W-2, there's no W-2, there's no Schedule C, and the IRS is going to send you a penalty notice that you owe a penalty equal to 6%. It's called excess contribution penalty, 6% of the amount that you contribute to your Roth IRA. So if you put $8,000 into your Roth IRA, in addition to backing out the $8,000 you put in there, you're going to owe a penalty of $480.
So that doesn't sound like it's worth it.
You don't want to do that. You don't want to do that. Um, you know, these laws, they seem a little complicated, and they are. And I have a slide with one, I think my final slide. Before you do anything when it comes to contributing to IRAs, please talk to a qualified financial advisor who knows all the rules. You don't want to pay. I hate IRS penalty. I'm also an accountant. I have an accounting and tax practice, and I tell my clients, I hate those IRS penalties. And I don't want you paying that. It's money thrown out the window because it's not necessary. If you knew all the rules, you wouldn't be subject to penalties. No one expects the ordinary person to know all the rules when it comes to these penalties. That's why you need a qualified financial advisor who knows all the rules. Any other questions?
And is there any limits on these contributions, I would say post-retirement contributions, if you're already taking Social Security?
Great question. Great question. And the answer is no. No. Again, Social Security is another, it has nothing to do with these distributions. You can be getting your full Social Security check and contributing to an IRA, taking money out of the IRA. Yeah, it has no effect whatsoever. The only thing I want to mention is that Social Security is taxable if your income is above a certain level. If your adjusted gross income is above a certain level, you have to pay tax, federal tax, not state tax, on your Social Security distributions. So my feeling is the best way to get around that is that we're going to be talking about Roth IRAs here in a moment. That if you have a Roth IRA, the money you take out of your Roth IRA is not going to be including your income. You don't pay any federal state tax. So therefore, it'll have no effect on on the taxation of your Social Security.
Okay.
Okay.
We have another question that came in. How do donations work from IRAs or other retirement plans?
Let's hold off on that because I'm going to be talking about a little later with something called qualified charitable distributions. So Matthew, if we can hold that question to the
Sure.
end,
Sure.
okay?
Yep. All right, well, that's all the questions we have for now.
Okay, great. Keep them coming, keep them coming. All right. Qualified distribution, tax rules on tax deferred accounts. These are tax deferred accounts. What does tax deferred means? Means that you're putting the money in to these accounts. Your account is accruing earnings depending on how you invest it. We're talking about you may want to put your IRA custodian might be at the bank, and you have it. Your IRA is invested in a CD, accruing interest. Interest is not taxed. Okay, that's the interest that you're accruing in that account will be taxed when you withdraw the money from the IRA. That's why it's called tax deferred. So we're talking about traditional IRAs. We talked about SEP IRAs, traditional simple. There's another type of IRA for self-employed individuals. It's called a simple IRA. Simple IRA. It's similar to the SEP, but there are some differences. We're talking about traditional 401k plans, traditional 403b plans. Note the following. The contributions are tax deductible. We're talking about getting a tax break. You're saving taxes on the front end, the year that you contribute to the traditional IRA. It's called a deductible IRA, or to a 401k plan. The contributions that are coming from your salary from the 401k plan, 403b plan, are coming from your gross salary before federal and state income taxes. So therefore, they're federal, the contributions are federal and state tax deductible. So again, my example, Joseph Smith has $100,000 gross salary during 2024. He decided he wanted to put $10,000 into his traditional 401k plan. His federal and state taxable income, it'll show up on his W-2 box number 1, it says taxable wages, will be $90,000. And then the $10,000 goes into his account, and any earnings that you get will be tax deferred. Okay. Then when Joseph Smith takes money out of the 401k plan, he's going to have distributions. That's when he's going to pay federal and state income taxes. Some states, like New York, exclude a portion of qualified plan distributions from state income and local income taxes. I'm sure most of the people listening today are from New York. I have a client. She lives in New York, and she's a federal retiree. She has this thrift savings plan, which is like a 401k plan. I do her taxes every year, and the state of New York excludes from New York taxable income $20,000 of money coming out of her thrift savings plan. Again, it's a 401k plan. New York does not tax the first $20,000. So my client got a break when she contributed to the thrift savings plan, when you put the money, a state tax break when she put the money into the traditional TSB, and now she's getting a little bit of a break when she takes money out. Okay. Employer-sponsored qualified plans allow penalty-free, no 10% or withdrawal penalty if the owner leaves or retires at age 55 or older. 55 or older. So that's also important. Any questions about qualified distributions, the tax rules? Okay. All right. Now we're going on to something that seems to be a lot of people's favorite these days. I know it's one of mine. Tax rules on Roth accounts, Roth IRA. Now, what exactly is a Roth IRA? Okay. First bullet says that Roth IRAs are funded, the contributions, with after-tax dollars. Now, how can that be, after-tax dollars? Well, let me just say this. IRAs in general, the contributions that you make from your IRA can come from anywhere. From anywhere. It doesn't have to come from your salary. Let's say you have a savings account, a passbook savings account, or a money market account. You got a nice amount of money there. That's your, among other things, that's your emergency fund for those bills that you may have every day. You know, you got a major repair on your car. You have to replace your washing machine. So you have that money set aside. It's in that savings account. Why do you have it there, money market account? Because you want to have access to the money. You don't want to have to be subject to any penalties if you take the money out. That's why we have a so-called emergency account. Emergency account. Everybody should have, my opinion, how much money in that emergency account? I say on average, 3 to 6 months. 3 to 6 months of your average monthly expenses should be in, at least 3 to 6 months of your average monthly expenses should be sitting in a liquid account. Liquid meaning it's not earning much, but the point is you can get to it at any time without penalty. So you have a nice amount of money in that liquid savings account, and you could use that money to make your contribution to your IRA. So in the case of a traditional IRA, I mentioned, I said I mentioned that a contribution that you make to your traditional IRA is with before tax dollars, before using pre-tax dollars, pre-tax dollars. So how can you get pre-tax dollars from your savings account? And the answer is, when you file your federal income tax returns, there is a line on your federal income tax return. It's called IRA contribution. And that IRA contribution is actually an adjustment to your income. So if Joseph Smith, in our example, has a traditional IRA, and this year for 2024, he wants to put in, he's over 50, he wants to put in $8,000 to his traditional IRA. He takes $8,000 out of his liquid savings account and puts it into a traditional IRA. And when he files his 2024 income taxes this spring, he's going to list on that on I think it's on Schedule 3 of IRS Form 1040. It's called Adjustments to Income. There's a line that says IRA contribution. He's going to list $8,000. What does that do for him? Well, let's say Joseph Smith's gross income is $130,000. As his gross income, as a result of putting in $8,000, making an $8,000 contribution to his deductible IRA, his adjusted gross income is going to be reduced to $122,000. $130,000 gross, $8,000 contribution to IRA reduces his $130,000 gross to $122,000. If Joseph Smith is in a 22% federal tax bracket, that $8,000 contribution saves him what? $1,760 of federal income taxes. Ditto for New York, except it's going to be, New York has 10% tax rate, so he's saving another $800 from New York. That's a traditional IRA. Roth IRA is different. The contributions that you make to your Roth IRA are made with after-tax dollars. So in an example here, a different person. Let's go to Mary Jones. Mary Jones is working. She has earned income. She loves that Roth IRA. She's under age 50. So how much can she put into her Roth IRA for 2024? $7,000 because she's under 50. So Mary Jones, she has a nice amount in her savings account. She takes $7,000 and puts it into her Roth IRA. Any tax break? No. Nothing on IRS Form 1040. It's not even reported. She just gives the $7,000 to her Roth IRA custodian, and that $7,000 is going to grow, accrue earnings. So what's the big deal? Well, let's look what it says here. The Roth IRA accrues earnings over time, interest, dividends, capital gains, whatever. But here's the bottom line. Roth IRA withdrawals are tax-free. That includes the contributions you put in your Roth IRA were already taxed. We know they're not going to be taxed, but it's the earnings that the Roth IRA has that are growing tax-free, compounded growth over time. But you got to meet 3 conditions in order to take the money out of your Roth IRA tax-free. Number 1, the Roth IRA owner has to be over 59 and a half, or if they're permanently disabled. Number 2, the Roth IRA owner must have had a Roth IRA open for at least 5 tax years. For at least 5 tax years. That's the first one they opened up. Only goes back to the first one. Tax years are considered to be January 1st of the tax year when the first Roth IRA contribution was made. So let's do an example here. Well, let's go back to Mary Jones. How long have Roth IRAs been around? Since 1998. Well, turns out that Mary Jones made her very first Roth IRA contribution on July the 27th, 2012. All right. So go back to January 1st, 2012. Go forward 5 years. Where does that bring you to? January the 1st, 2017. Well, it's now 2024. Let's suppose that Mary Jones is going to be had to turn 60 years old this year. She turned 60 years old this year. What that means is if she turned 60, let's say she turned 60 years old this year. Let's say she turned 60 in August. That means she turned 59 and a half back last February. So as of March 1st, 2024, Mary Jones can take money out of the Roth IRA, all of it, if she wanted to, not pay any tax. Okay? Not any tax, because she met the two conditions. She's over 59 and a half when she took the money out. Number two, it's been at least 5 years, 5 tax years since Mary Jones made her very first, only the first one, Roth IRA contribution. Now, keep in mind that if you don't meet one or both those conditions, then the distribution is non-qualified. In that case, the Roth IRA owner will owe taxes and possible penalties if they're under 59 and a half, a 10% withdrawal penalty on the earnings portion of the Roth IRA. Any questions regarding Roth IRAs?
I've got one for you, Ed. Suppose you're of retirement age, you have significant assets, maybe not too significant, maybe a couple 100,000, that are not in an IRA. And you're doing pretty well in the stock market, and you notice you have to pay taxes on those earnings. So you think, all right, maybe I should put these in a Roth IRA. But it sounds like, first of all, you're going to lock the money up for 5 years. But if you can get through that, then anything you earn in that would be tax-free. Is that correct?
Well, you're right, but here's the problem. Here's the problem. You just can't transfer money from your brokerage account. We're talking about your stock, your equities, your stocks, your equities, right into a Roth IRA. You have to make contributions to your Roth IRA. Okay, and you have to have earned income to do that. Now, if you have earned income, you could put like this year up to $8,000 if you're over 50.
I see. Okay.
Okay, you got to make contributions. The only thing you could do, though, if you want to get that Roth IRA, is that if you have a traditional IRA, you can convert it. You can convert the traditional IRA to a Roth IRA. There is no income limitation for that. You don't have to have earned income. The only problem is that when you convert a traditional IRA to a Roth IRA, you have to pay taxes on the amount of the traditional IRA you're converting, federal and state. And if it's a huge traditional IRA, you're going to be facing a huge tax liability. You should only do that when consulting with your tax advisor. The best thing to do is to not do it all in one lump sum. Do it, in a whole one swoop. Do it over a period of time, from over the years, converting those traditional IRAs to Roth IRAs.
So, because if you were to do that, all that money basically constitutes as if you suddenly earned all that money in 1 year, and you're going to get taxed on it.
Yeah, you got to pay tax. You got to pay tax in full of the amount that you converted in any 1 year. So if you converted a let's say you have $100,000 traditional IRA, and you're going to convert it to a Roth IRA, that $100,000 is going to be added to your existing income for the year. It could push you into a higher tax bracket. So before you did this conversion, before you did the conversion, you were in a 22% federal marginal tax bracket. But as a result of converting that traditional IRA of $100,000 to Roth, it's adding $100,000 to your taxable income. You are in a 24% tax bracket.
I see.
So you owe 24% of $100,000, which is $24,000 in federal income taxes. Live in New York, that's another 10%, that's another 10,000. And the IRA custodian will not withhold the taxes from the distribution. You have to have that money available in liquid assets to pay the taxes too.
Oh, I see.
And you do not want to do this on your own. You have to work with a qualified tax advisor. Any questions?
Interesting. Thank you.
Okay.
I do have a question here.
Yes.
Can they put RMD into a Roth IRA?
No. When you are, we're going to be talking about RMDs here in a few moments, but let me just say this. When you have to start taking RMDs from your qualified retirement plans, from your traditional IRAs, it's just a minimum you have to take out, and that money that's coming out, it's just a minimum amount. So you can take out more, but it's the minimum you take out. It's yours to spend, but you can do anything you want with it. You got to pay federal and state taxes on the amount you're taking out. But once you have the taxes, it's your money to do whatever you want. You cannot roll that money back into the retirement plan or IRA. You cannot make a contribution to a Roth IRA. Again, now, if you have earned income, though, you or your spouse earn income, you can use that distribution as a basis for contributing to the IRA. The money, when you make contributions to the IRA, the IRS doesn't care where it's coming from. But it can't come directly from the retirement plan, RMD, right into the IRA. You have to pay tax, and then after you pay the tax, you can do whatever you want with it, including contributing to an IRA. But again, you have to have earned income. Any more questions?
That's all we have for right now. Okay.
So let's talk about these penalties again and the penalty exceptions. Early withdrawals pre-age 59 and a half from an IRA are subject to 10% early withdrawal penalty unless an exception applies. One exception is if you are permanently disabled and you have a traditional IRA, you could be any age. You don't have to be at least 59 and take the money out and not be subject to a 10% early withdrawal penalty. The other exception is that if you have an IRA you built up over the years and you pass away, you've named a beneficiary of your traditional IRA. It could be anybody. It could be your spouse. It could be your children. It could be your sibling. It could be a good friend. They have to take the money out within 10 years of your death. But no matter what their ages is, they're not going to be subject to a 10% early withdrawal penalty. They have to pay tax. Federal and state, but no early withdrawal penalty. So if you have a traditional IRA and you name, let's say, your grandchild is 20 years old, and you pass away, and your grandchild is going to be the beneficiary of, let's say, whatever's left in your IRA, $40,000. Your grandchild has to take the $40,000 out. It's called an inherited IRA. Within 10 years of your death, they don't have to take out a minimum during the 10 years. They can wait to the very, very end of the 10-year period, following your death. That's not a good idea, though, because the longer it's in that IRA growing over time, the more they're going to have to take out. So taking out $40,000 plus could push them into a higher tax rate. They're best off taking the money out over a period of time within maybe 10% each year for 10 years, paying the tax, but no penalty. Okay. Okay. Employer sponsored retirement plans such as 401ks allow penalty-free withdrawals if the plan participant retires or leaves the company at age 55. They said these are the qualified retirement plans. They're not IRAs. IRAs it's 59 and a half. When it comes to qualified retirement plans, it's age 55. For IRA account holders, there are some exceptions. For taking money out of your IRA, the traditional Roth, and not be subject to a 10% early withdrawal penalty. Let's go through these exceptions. One is if you are a first-time home buyer, you can take money out of your IRA before age 59 and a half to help pay for your first house, up to $10,000. When I say help to pay for your first house, that's a down payment. Or for your closing costs, to make immediate improvements to your house when you first, like within the first month or so, you're making some major have some major expenses. You could take up to $10,000 out. Now, if you're under 59 and a half, you have to pay federal and state income taxes, but no 10% or withdrawal penalty. If you're unemployed, and you have to pay, and you're not, no income's coming in, you can take money out of your traditional IRA to help pay for your medical insurance premiums. This is not for retired people. These are people who are still they're still working, but now they lost their job. Here's something interesting. You can take money out of your IRA for higher education expenses. What, you're going to go back to school? No, but suppose you have family members, children, maybe grandchildren. You want to help pay for their higher education? Yeah, you can take money out of your IRA and to help pay for the higher education expenses. No, with no penalty.
And these aren't considered loans that you have to pay back?
You mean the money coming out of your IRA?
Yeah.
No, on the contrary, you're not allowed to borrow from your IRA. If you borrow from your IRA, you take out a loan, it's going to be disqualified. Meaning you have to, it's going to lose its qualification as an IRA. You're going to have to take everything out and pay a penalty. This is not a loan. You're just, the idea here, taking the money out in case of higher education, you have no intention, have no intention to put the money back in there. You're going to use it. When the money comes out, you pay federal and state tax. Use that money to help pay for maybe you're going back to school, maybe your spouse is going back to school, children are going to go to college, or vocational school. Maybe you have grandchildren. You want to help your grandchildren. So again, but no loans. IRAs are not, you're not allowed to take out loans from your IRA. As opposed to 401k plans, they allow you to take out loans. I really discourage that. Your 401k plan, your 403 should not be a bank. Should not be a bank. You don't want to borrow from it. And many times people do that and they regret it. They pay the payment back. Okay. Let's move on, talk about something related to qualified distributions. It's called direct and indirect rollovers. Okay. Now, this is happening so often this day and age, where individuals change jobs. They change jobs. They were at one company, 401k plan. Then they go to a different company, has a different 401k plan. Okay. And the question comes up, well, I left my previous company. What can I do with my 401k plan with that company? What can I not do with that 401k plan? Let's do the easy one first. What can you do with your 401k plan? Leave it there. Leave it with the company. You cannot, what you can't do is you can't contribute to it. Will the 401k plan with that previous company still accrue earnings? Yeah, will grow. Yeah, it's going to grow. It's going to grow. You just cannot contribute to it anymore. So is there any downside to that? Well, one downside is you're even though you can't contribute to it, you cannot contribute to it, you're still paying fees. And some of these retirement plans have high fees, administrative fees. You got to watch that. So what are you going to do? Well, one option is that you are allowed to roll over all the money in that previous company's 401k plan into a traditional IRA that you're going to control. Is that a good idea? Well, many ways, yes. Well, first of all, you're in full control of the IRA. It's your IRA. You can figure out, you can determine where you want to invest it. Can you contribute to it if you have earned income? Yeah, this is a traditional IRA. Now, another possibility is you have a the new company you're going to has its own 401k plan. If the new company 401k plan accepts rollovers from another 401k, you could do that. Not all companies allow that. There's no law that says they have to accept it. But if they do, you have that option. Is that advantageous? Is that a good idea? Well, this way you have everything under one roof. There was a study done a year ago that shows that Americans have changed jobs a lot over the last 10, 15 years. And when typically what happens is many employees, when they leave a company, forget that they left money in the company 401k plan. They forget about it. And then this goes on for years, and then they die. And the company still has that money. What are they going to do? They don't know where the person went. It's sitting there. I think the study showed that there's currently $29 billion worth of retirement money that individuals have lost track of. This is a big problem. So if you're going to leave one job and go to another job, you're encouraged to take the money with you, either put into a 401k plan or to the new company 401k plan. And then, once you do retire, you have all your money in one retirement plan or one IRA. This way it'll make your life better, because when you pass away, you have definitely going to have the IRA. You've named beneficiaries. Same thing is true with IRAs. Some rollovers occur when an IRA account holder wants to switch to an IRA with better benefits or investment choices. Okay. Let's be careful here about rollovers. There are two types of rollovers. Direct rollovers, in which the retirement plan administrator transfers the plan's proceeds directly to another plan or to an IRA. Directly. It never comes to the retirement plan owner. A rollover means that the retirement plan administrator sends a check for the retirement plan to the amount of retirement plan the amount of money in the retirement plan minus 20% federal income tax withholding. Why? Because the check is made out to the retirement plan owner. You don't want that. You don't want that. You don't want that withholding. So a better way to do it is a direct rollover. Direct rollover means that the retirement plan administrator transfers the money directly to another plan or to an IRA without coming to the retirement plan. There's no withholding. Okay, that's what I just mentioned. Where it comes to the employee or to the IRA owner, is an indirect rollover. You don't want to ever do indirect rollovers. Okay. A direct rollover, but not an indirect rollover, is considered to be a qualified distribution. Under IRS rules, only one indirect rollover per 365-day period. The IRS about 10 years ago came up with this rule. You only can do one indirect rollover per 365-day period. This is not calendar days. This is actual 365 days. That's a year. but it's not necessarily January 1st and December 31st. If I did a rollover today, well, today is December the 3rd. I did a rollover. Then I did a rollover today, December the 3rd, 2024. I am not allowed to do my next rollover until December the 4th, 2025. When it comes to direct rollovers, any number you want. There's no restriction. It's just with indirect rollovers. Now I want everyone to put up their antennas. What does it say here? Qualified distributors. Beware of fees and scams, ladies and gentlemen. You've heard of senior abuse? Oh, have I seen this happen so often? IRA owners, particularly those who are retired, they're over 59 and a half, should be aware of fees and scams associated with IRA direct rollovers. You may get emails, you may get phone calls, you may get offers in the mail from stockbrokers, insurance agents, promising the world if an IRA account is transferred to an IRA under their investment control. Be sensitive to the cost of owning any IRA. There is no IRA out there that's free. Every IRA has fees, custodial fees. And some of these custodian fees are god awful. And there's also investment expenses. Particularly beware of investment advisors who churn client investment accounts, including IRAs. What do I mean churn the accounts? Well, they put you into a certain mutual fund this year, and then maybe 6 months after they did that, they said, I got something better. And you're in that fund, you're in that mutual fund, let's say for 3 months. And then they come out, oh, I got something even better. Understand, every time they purchase some, on your behalf, a mutual fund, they get a commission. Then they sell it, then you sell the fund, then they put you in something else, they get another custodial, they get another commission. It's called churning accounts. Ladies and gentlemen, I'd like to summarize this by saying this. Please beware of all the selling going on in this day and age. And when it comes, particularly to your IRA, it's not only what you're earning in terms of how the IRA is growing. It's not only, it's not only what you're earning, it's what you're keeping in the end. In the end, when you take money out of that IRA, you got to remember, you got to pay taxes in case of a traditional IRA. Okay, Roth IRA, no taxes. But in the meantime, all the years you've owned the IRA, what are the expenses you're paying for the type of investments that you're in? High administrative expenses, custodial fees, all kinds of stuff out there that's it's going to minimize the overall investment return. It's not only what you're earning, it's what you're keeping in the end after you pay all the fees. I want to point out that for 20 years, I was a licensed investment broker. I worked for several companies. And the only thing these companies always would push me, they would say, you have to sell, sell, sell. You have to sell, sell, sell. And I kept saying to them, I'm not a salesperson. I'm a financial planner. It got to the point I got so sick of it. All these rules and regulations, how much I have to earn, how much I have to sell each year. I had the heck with it. After 20 years, I gave up my license, and that was in 2015. So for the past 10 years, I'm the happiest person around. Trying to explain, particularly to senior citizens, why they got to be very, very careful when it comes to their investments. There's no lack of salespeople out there. So please keep that in mind. All right, so let's summarize what we just went over. Qualified distribution summary. Qualified distributions are withdrawals from qualified retirement plans such as 401k, 403b plans, retirement plans, and IRAs. To be considered qualified, distributions and withdrawals must meet certain IRS rules. And if withdrawals fail to meet these rules, the amounts can be taxed at regular income tax rates and may face an additional 10% early withdrawal penalty. Any questions before we move on to another aspect of qualified distributions known as required minimum distributions? Any questions, please?
Yeah, we do have one question, Ed. If you have a couple of different types of accounts, say a Roth IRA and a SEP IRA, for example, is there a recommended order for taking distributions from these accounts?
Good question, and I'm going to include in different types of IRAs, traditional IRAs and Roth IRAs. When it comes to Roth IRAs, you should delay as long as possible taking money out of the Roth IRA. Roth IRAs are the only type of accounts, qualified accounts, that are not subject to RMDs. You don't never have to take the money out. So you want that money to be in there as long as possible. As far as traditional, you mentioned traditional IRAs, SEP IRAs. You should start taking money out of your traditional accounts probably when you get to your mid to late 60s. And the reason I'm saying that is because when you reach, and we're going to talk about this next, something called your required beginning date, your RBD, you have to take out each year a minimum from your RMD, from your IRA. It's called the required minimum distribution. And the larger your RMD, and it's based on the larger your account balance in these traditional accounts, the more is going to be your RMD, the more taxes you have to pay. So it's a good idea to start taking money out of your traditional accounts, traditional IRAs, traditional contributory IRAs, traditional and SEPs and simple IRAs. I would say in your mid to late 60s, because this way it'll result in a lower balance by the time you reach your required beginning date, and your RMD will be minimal. Here is a planning suggestion I always mention to my clients. When can you get Social Security? What is the earliest age you get Social Security? 62. If you take Social Security at 62, your Social Security benefit is going to be reduced. Why? Because you're under your full retirement age. What is full retirement age? Well, for most people now, it's between 66 and 67, depending on what year you're born. I happen to be born 1951. My full retirement age is 66. I recommend, though, if possible, wait to take your Social Security until you're 70. Because if you wait till 70 Social Security, your Social Security benefit will be the maximum benefit possible. In my case, by waiting till 70 to start taking my Social Security, I got 32% more in my Social Security monthly benefit for the rest of my life compared to had I started at my full retirement age of 66. So the question comes up, well, I'm not getting Social Security. What am I going to live off of? Your traditional IRAs, traditional 401k plans. Use that money to pay your bills and hold off on Social Security, because Social Security is guaranteeing you, the Social Security Administration, for every year you wait past your full retirement age to start taking Social Security, Social Security says, we will give you 8% per year up to age 70. So in my case, that's 4 years. I'm getting 32% more each year in Social Security because I started at age 70 compared to starting at my full retirement age of 66. So those are some of the reasons I say take those traditional accounts in starting your mid-late, because you can use, first of all, it'll cut down your RMD, okay, when you reach that required beginning date. And second of all, it'll allow you, if you can afford it, hold off on to take Social Security and use the money from your traditional accounts to help pay your bills. Any other questions?
Ed, didn't the IRS just raise the age limit for RMDs?
Yeah, we're gonna get to that next. Yeah, they did. They did. Okay, they did. I'll give you the specifics here in a moment.
Okay, we did have a question come in from Jennifer. Where does company 401ks fall into this schedule?
For RMDs,
Yes.
yeah, everyone 401k plans have their are subject to RMD rules too, and so you have to, when you reach that required beginning date, you have to take out an RMD from the 401k plan, and the administrator of the 401k plan will let you know what that is every year. They'll let you know what that amount is. In fact, let's talk about that right now. Okay. So what are required minimum distributions? What are RMDs? RMDs limit the time retirement assets can grow tax deferred. Tax deferred. Okay. Qualified retirement plans, here it is, 401k plans, 403 plan, for instance, and traditional IRAs are required each year to withdraw a minimum. I emphasize the word a minimum. You could take out more from their retirement accounts. Let me emphasize something here. An RMD is not a penalty. Some people take this the wrong way. I mean, I've heard um, from individuals the following: "Oh, the government is forcing me to take money out of my retirement account. Why is that?" And my answer to that is, look, all these years, the government has allowed you to have your retirement assets in your 401k plan, your traditional IRA, to grow tax deferred. You haven't paid any tax whatsoever all these years. Now that you reach that age, that required beginning date, the government says, all we're asking you is take out a minimum. It's your money. They're not going to take any of your money. Of course, you got to pay the federal and state taxes due, but whatever's left is yours. And the person says, to do what? I said, spend it. Take a trip. Go on vacation. Buy a new car. It's your money. Make a gift. Give it to your children, grandchildren. It's your money. They're not taking anything from you except the taxes. Now, when does this start? It's called the required beginning date. The question we had. Okay. And next slide, I'll show you what that required beginning date is. Starting at one's required beginning date, RBD, a qualified plan participant, and a traditional IRA must take an RMD. RMDs are qualified distributions. There's an IRS penalty for not taking an annual. If you don't take your RMD, IRS will impose a 25% penalty. 25% of what you were supposed to take out, you didn't. Pretty tough about that. It used to be a 50% penalty. All right, so what is the RMD? We had a question, RMD, okay? Everybody think about when they were born. When were you born? Okay, so what is the RBD? It's April 1st following the year, a retired qualified, there's double qualified there, a retired qualified retirement plan participant or a traditional IRA owner becomes age 70 and a half. If you were born before July 1st, 1949, your RMD was April 1st following the year that you turned 70 and a half. If you were born between July 1st, 1949 and December 31st, 1950, your RBD was April 1st following the year that you turned age 72. If you were born between January 1st, 1951 and December 31st, 1959, your RBD is April 1st following the year you turned 73. Like me, I was born in January 1951. So my RMD is April 1st following the year I turned 73, which, by the way, is this coming April, because I turned 73 in this past January. Well, I've already taken my RMD. This is the deadline. But I took my RMD back in last March. And what did I do with that money? We got a new roof. Believe me, it's not the roofs. New roofs are not cheap, so I used the money. See, again, it's your money. Do anything you want with it. So we got a new roof for the house. And if you're born after December 31st, 1959, your RMD, your RBD, required beginning date, will be April 1st, following the year turns 75.
And it seems if you were born early in the year, that you really get an extra year.
That is correct. That is correct. It said, say, like in my case, again, I was born January 1951. I turned 73 in January 2024, which means I really didn't have to take my first required beginning, my first RMD until April 1st, 2025. I had more than a year to take the first one. But here's the situation. Here's the situation why I recommend individuals do not wait until that April 1st. Let's suppose let's say I would have waited till February 2025 to take my first required minimization. I could have without penalty, and there'd be no penalty. The problem is that if I would have taken my first RMD, if I took it in February 2025, I'd have to take a second RMD for the year 2025 because RMDs are taken every year. It's just that first year they gave you an extra 3 months. So if I would have taken my first one in February 2025, I'd have to take my second RMD no later than December 31st, 2025, and that would be more income. More taxes probably. Okay, not only taxes, but I'm also enrolled in Medicare Part B, and the more your income, the more you have to pay for Medicare Part B. So that for those reasons, that's why I took it. I spread it over 2 years. But after the first year, it has to be taken. Your RMD and your IRA custodian will tell you what your RMD is. They send you a letter usually in January what your RMD is going to be for the year. They compute it. Okay. There's
So
also,
sorry.
go ahead.
So the distribution counts as income, but not earned income?
It's anything associated with a pension or an IRA distribution is not earned income. It's pension income. There's a difference. Earned income, I call it the sweat income. You have to sweat to get it, right? You have to sweat to earn a salary. You have to sweat to get your self-employment income when you're working for yourself. But when it comes to investment income, passive income, like for example, you're getting interest, you're getting dividends, capital gains. When you get money out of your IRA, it's coming to you. You don't have to sweat to get it. You put the money in, it grew. Now you take the money out. It's not considered to be earned income. Any questions? Another part of RMDs is that when you pass away, you have an IRA and you name the beneficiary of your IRA. When you pass away, then your beneficiary is subject to RMD as well. They have RMD rules for that. It's called beneficiary RMD rules, which I'm not going to get into. They're a little detailed. If you inherit an IRA from someone, it does not have to be, let's say, from a parent. It could be from a sibling or a good friend named you as beneficiary. You have to take the money out of that IRA. You have to take it out actually within 10 years. If the IRA owner, traditional IRA was over their required beginning date, then you have to take out. Then you have to take the money out, and the deceased IRA owner was taking RMDs, and you're going to have to take RMDs, and it's very complex rules. I'm not going to get into it. You definitely have to meet with a qualified tax advisor. Any questions? Okay. RMDs and penalties. There is an IRS penalty for missing RMDs. Qualified retirement plan participants and traditional IRA owners are advised here, please, to meet with a qualified financial advisor. Who is a qualified financial advisor? They're a CPA, a CFP, which stands for Certified Financial Planner, EA, which stands for an enrolled agent. Enrolled agent is someone who is licensed by the IRS to prepare tax returns and to answer questions about tax rules. And then, of course, a tax attorney to review your RMD rules in order to not be subject to any penalties. You don't want to be subject to this penalty. Again, I hate IRS penalties. They're not necessary. If you don't understand the rules, then meet with someone who does. Spend a few dollars. It's worth it. It's worth it. And finally, I'd like to talk about qualified charitable distributions, QCDs. What are QCDs? We had a question about charitable distributions. Let me explain about qualified charitable distributions. These are called QCDs. QCDs are qualified distributions from a traditional IRA to a qualified charitable organization. Who's a qualified charitable organization? A church, a mosque, a synagogue. Oh, how can I forget PSS? I see some happy people here. Okay. You can make a qualified charitable distribution to any of the above I just mentioned. So what's the benefit? What's the benefit? Okay. Well, let me just say there's a limit how much you can make each year to in a QCD. So this year, the limit is $105,000. We still have a few weeks left in 2024. I'm not saying put $105,000 in. So what is the benefit? What is the benefit of doing a qualified charitable distribution? Okay. First of all, you have to be over 70 and a half to do it. If you're younger than 70 and a half, you cannot make a qualified charitable distribution. Okay. The qualified charitable distribution has to be made by your IRA custodian. Not you. You are the traditional IRA owner. They have to make the distribution on behalf of you. Now come the benefits. A qualified charitable distribution is not taxable. You're taking money out of your traditional IRA. If you pulled money out of your traditional IRA, let's say you took out $10,000 and said, listen, that's my money. Okay. I'll pay the tax, federal and state tax, and whatever's left, I'm going to give to my church, synagogue, or the mosque. That's my charitable contribution. Okay. So what is the benefit there? The only benefit is that if you itemize on your federal income taxes, you can count that contribution as a charitable contribution. And if you itemize though, you file Schedule A on your federal income taxes, will you get any tax benefits? It's deductible. Ladies and gentlemen, under the current tax rules, result of the passage of the Tax Cuts and Jobs Act of 2017, most Americans do not itemize. They take the standard deduction. The standard deduction has been doubled. The Tax Cuts and Jobs Act of 2017 passed in 2017. It's only temporary. It's due to expire on December 31st, 2025. With the new president going in, President-elect Trump, and a Republican, both houses of Congress, President-elect and congressional leaders are going to, looks like they're going to extend the Tax Cuts and Jobs Act of 2017 into the near future. At least for the next 4 years. I know that. So what I'm saying is, because if you don't itemize, you take the standard deduction, and most, as I say, most people do. Taking the money out of your IRA, paying the taxes is useless. And you're not getting any. Don't get me wrong. You don't make contributions to your favorite charities in order to get benefits. You want to benefit the charity. Now comes the QCD. With the QCD, going back to my example, you have a traditional IRA. You're over 70 and a half. You have that favorite church. Let's not forget PSS. You want to give PSS $10,000 for all the good things they do. They deserve it. So you contact your IRA custodian and say, listen, please send a check made out to PSS for $10,000 from my IRA account. My IRA account. So how do you benefit? The QCD is not taxed, is not deductible. Well, who cares? You take the standard deduction. You don't itemize. It wouldn't do you any good anyhow if it was deductible. Okay? You take the standard deduction. But look at this. Your QCD counts towards, if you reached your required beginning date, towards your annual RMD. When you reach your required beginning date and you want to, instead of having to take that RMD, paying the taxes, you could use your QCD in place of your RMD. What's the benefit for that? Remember, I said earlier that your RMD is included in your income. You got to pay federal and state tax. QCD is not going to be included in your income. It will count towards your RMD. That's the benefit to you. It's tax efficient because the QCD does not increase additional IRA's adjusted gross income. It's not including your income, therefore your adjusted gross income will not be affected. You could, if the result is you may not have to pay tax on your Social Security benefits because the QCD counts towards the traditional IRA RMD. Traditional IRA may not have to. It may have to. You don't have to take your RMD from your IRA. That counts dollar for dollar towards your RMD. If your RMD is let's say $8,000, and you do a QCD of $8,000 to your favorite charity, you don't have to take $8,000 from your traditional IRA. All right. Any questions about QCDs or anything else I covered today?
Ed, do you think a fair number of people don't know this and they take their distribution and they make their charitable contribution and could save themselves a little money in between if they recognize this?
You know something, Matthew? The answer is I think that a lot of people don't know about QCDs. They're not aware of it. And that's why I'm forever grateful for sharing this information. So people now know about it. You know? And
Thank you very much.
again, you have to, keeping informed, I guess we have to, we financial planners have to, and tax advisors, we have to spread the word. So to answer your question, yes, I think a lot of people don't know about this. Senior people over 70 and a half do not know about QCDs. And these individuals, fortunately, are very charitable. But and again, I say, the idea of being charitable means not what's in it for me. You want to give to your favorite charity for the sake of for helping the charity. At least this way, you're getting some benefit in terms of not having including that money from your IRA and income.
Sure.
And this could help you, and it'll save you on federal and state income taxes.
Sure. Yeah, for a lot of really generous middle-class contributors. Sounds like a great idea. Well, thank you very much. We've gotten a number of thanks in the chat for you. Ed, yeah, if you want to put up your information again there, so anybody can write that down.
Okay, I just want to. Okay, I want to thank everyone for having me as a webinar speaker today. Thank you for all your great questions. I love it. I fortunately in my life I've never gone through a whole webinar with no questions. But I always say the more questions, that means more participation. It just makes me so much happy. I want to wish everyone an enjoyable and safe holiday season and happy and healthy New Year 2025. Please stay well, be safe, and I hope the information I presented today will be of benefit to you. Particularly, we talked a lot about IRAs, and if I've given you some, maybe an incentive, maybe to go back to work, even again, only part-time. Let me just mention something again, what I said about that. We had the question, can you still contribute to your IRA, even though you may be taking money out of it? Yeah, the answer is yes, you can, but you have to have earned income. So for 2024, through 2024, maximum IRA contribution is 8,000. If you're over 50, it's going to go up, I think, a little bit in 2025. I haven't seen the final numbers yet, but the rule is that you can contribute to your IRA in any given year for this year in 2024. The lower of whatever your earned income is, gross wages or net self-employment income, or the $8,000. So if you get a job and you're earning $10,000, very part-time, you still can put the full $8,000 in. If your part-time income, your part-time job is paying you, let's say, $6,000 for the year, $500 a month, then you can put in $6,000. Whatever it is, the money goes in your IRA. It grows at least tax deferred. In the case of a Roth IRA, tax free. All right. Any other questions, comments?
So Ed, someone wants to know if we can send out the slides. I assume that'll be okay for.
Absolutely. You can
Yeah.
send out, share the slides as much as you want. Just don't sell them now, please.
Try not to. Well, thank you very much, Ed. Really, really appreciate this. We'd love to have you back sometime.
Okay,
And
will do. Will do.
I'm sure
Will
we're gonna
do.
get
Thanks
great.
again, Matthew. Thank you again for having me. Wish everyone the very best. Thanks for coming. Spread the word. We'll hopefully do it again sometime in the near future.
Okay. Bye-bye. Thanks, everybody.
Bye-bye.
Bye-bye.